Today, we're talking about syndication and self-directed IRAs. So syndication is just at that point when you hit your, I'd say, capacity and you've maybe got a bigger deal. How do you eat an elephant? One bite at a time. Many small people can kind of help out. So just a partnership between several investors, kind of combining skills, resources, capital in order to purchase and manage a property they otherwise couldn't afford. So your skills, abilities, kind of what you bring to the table might fit in here. You might be an excellent property manager, but you might not have all the cash, or you might be able to source the deal, but might not have the money to do so. This is where syndication comes in and partnerships. This works at a high level when you're shopping multi-million-dollar deals for, say, big apartment complexes or a hotel or things along that line, all the way down to just maybe property, right? You might have that deal, but you might not have the money. And so through these kind of resources and connections here at Grid is where we're able to kind of fund these partners and can help you do that. So that's what Will here is going to be able to speak of. Self-directed IRA is just an IRA that allows you to hold alternative investments that you can then leverage in the future. So that stocks or through real estate, unlike your IRA, your traditional IRA, which is consisting of stocks and bonds, things that are oftentimes traded out there on the open market. Your self-directed IRA provides a broader selection for investments for you. So just a vehicle that you're able to then dictate how you want that money leveraged out. You can combine those two, so you can use your self-directed IRA to go into a syndication. There's some spaces in there where, say, returns that come drawn, because that's going to have to go to the IRA, into your IRA. So with that, just seek your counsel, get with a great CPA, accountant, an attorney. They're going to help you structure those pieces in order to do that. I'll leave it out there as just as a quick question for anybody too. If you have experience in this, you might want to share a story. Now's a good time just to even kind of bring that up, because we're going to talk with our guest Will here. He's going to kind of do a little bit of a dive into a deal that he has an example of specifically. So Will, definitely want to pop up and kind of help guide us through it. I can shift this over if you wanted to use the whiteboard.
So what were you, Mark?
Well, if you wanted to share even your deal, right? Great example.
Okay. Yeah. Well, hopefully I brought some paperwork, but that kind of works. Don't work through the virtual world here. But basically, syndication is like you already said. It's kind of bringing together the interest. It doesn't have to necessarily be investors. It has to be interest. So a lot of times you have people kind of, let's see, say you find a deal. And you find that deal like I did, you negotiate that deal, you get it under contract, and then you go out and you need equity to take the deal down. You really need equity, you need your debt, you need your, sometimes you need a debt sponsor to how the property is. But the most part, you really got to look. Is this where we're going to structure?
Yeah, we can for sure. Yeah, if you want to break down, we can use the board.
We'll write down a little bit. It makes it a little easier. So
how's the camera?
Whenever you're looking at syndication, you bring it a little closer.
Yeah, for sure.
There we go. Whenever you're looking at syndicating a deal, you really need to pay attention to the numbers, meaning that you obviously don't want, as a general partner, a GP, you don't want to give away the farm, right? You don't want to get everything. But at the same time, you got to be fair to your investors. You got to make sure that you're giving them a solid return, something that's going to coax them in. Talking about the self-directed IRA, we use those a lot. And you've got to understand that sometimes, it's a chore for an investor to pull their funds out of say the stock market, put it through a self-directed IRA, go through all the process, all that, in order to invest in your deal. So you got to make sure it's lucrative for them. You got to make sure that it's that it's worth it, right? But at the same time, you can't give away the farm, because as a GP, a general partner, which I'll explain in a second, you got to make sure that it's worth your whiles, worth your time as well. So really, in a syndication, you really got up here is your syndication, and you really got two facets of it. On one side is the GP, which stands for general partners. So a general partner is going to be typically it's the sponsor or general partner. It's the team or the person that finds the deal, that's putting the deal together, that's also considered the active So think of them as an active partner, meaning that they are actually finding the deal, negotiating the deal, putting in a contract, raising the capital. They're also going to be carrying out the business plan. So the business plan, a lot of times in multifamily, you hear about value adding. Well, value adding is considered the business. So they also are responsible for carrying out the business plan, right? I hope you guys can see that. On the other side, you've got your LP or your limited partners. Limited partners are going to be considered passive, means that they do not necessarily have a voting decision. They, outside of, they can vote out the GPs or rule them out if they find them doing bad stuff. But for the most part, they're really there just to bring the equity, which I probably need to go back and explain the equity. Your equities and your debt is really what takes of a deal. Think of equity as like a down payment in a house. It's your 20%, 30%. And then the debt obviously is your 60, 70, 80%, whatever you get. In this structure, let's just use a hypothetical here, I guess. You're going to look at, typically you have what's called a pref for your investors. I'm probably going to be all over the place with this. So a pref or a preferred rate of return, let's say is like this deal I got here. It's an 8% preferred rate of return. On this preferred rate of return, you got to understand the difference between cumulative and non-cumulative. So non-cumulative means that you get an 8% pref as long as you get 8% out of the asset, as long as it produces 8%. If it's cumulative, that means that they get 8% no matter what. So say the first year it kicks off 6%. You can only pay out 6% to them. Well, then the next year you owe them the 8 plus the 2 that you made up from last year, which would be a 10% pref. And that will continue to roll until a capital event, which is typically a sale or refinance upon the 3, 5, 7, 10-year mark. So you got your pref, which is in this case, let's say an 8%. And then you've also got your profit split. I hope you can see this. Which in this case is a 65% to LPs. And so basically, if somebody comes to this deal, I say, look, you give me $100K for this investment, you're going to get an 8% a year preferred rate of return. It means after I pay after I pay the debt service, whatever's left over out of the profit, the revenue of that asset, you're going to get the first 8%. And so say they get 8% and it's annual, so they would get $8,000. So let's say 8,000 would be their first, would be their annual distribution. And then say that there's another, let's just say hypothetically speaking, there's another 10,000 a month that is above this pref, okay? Above the 8%, there's another $10,000 a month. So 10 times 12, it's 120,000. They're going to get 65% of that. Let's make it 100,000. Let's make it easy. So 100,000, they would get an additional 65,000 that year. So this is the stuff that you've got to be able to analyze in order, because this is what the investors want to see, right? So their total average or annual return would be what? 73? 73,000. And so you would figure this, if you took 73,000 a year, divided 73K, divided by 100K, which is their initial investment, that would equal their what they call cash on cash return. And which in this case is 73%, which is outrageous. Yeah. We all want to get in on that one. But this is kind of I don't want to get too deep into the underwriting process of it, but you really need to understand right here is the first part, GP versus LP. Who's the GP? That means the active person, the people that are actually putting the deal together. LP is your limited partners, your equity partners. They're the ones that are bringing the down payment, right? And then, of course, you've got your debt, which is another, that's pretty much a commodity at this point. So you're really just shopping debt. Let's see, did you make any notes? Am I doing okay?
No, you're doing, no, you hit it. A lot of good just in there as far as what you're talking about. Sounds like kind of just a waterfall return, right?
It's a waterfall return. It breaks out. But here's the thing. Here's where you got to the magic happens, if you will, is you've got to understand that does this need to be a 6 pref and a 80-20 split, or does it need to be an 8 pref and a 50-50 split? Like that, each deal, when you're talking about syndications, number one, it's singular. It's per transaction. So you got this asset and this asset you analyze it, you underwrite it, it produces, this one produces $219,000 a year. So we have a definitive answers, of what it's producing compared to like a fund, a private equity fund, which we have some of those as well. But you have those numbers, and you basically want to manipulate those around a little bit, and you'll know pretty quickly whether, like when you're raising the equity, syndicating the process, putting these together, it's really become kind of a streamline. Like, I mean, we use an investor portal now to where they do, they handle all of our back office and K1s, distributions. They handle all the meat and potatoes. But the thing is it really comes down to the investors. You really need to get a good investor avatar. Know your investor, know who you're going after. Are you going after newly liquid entrepreneurs? Are you going after, medical professionals? Are you going after real estate professionals? Who are you going after? What are they looking for? What kind of returns are they looking for? Older, say, newly liquid, older business owners, maybe they just sold. Well, they're looking to kind of retire, right off into the sunset. They're okay with a safe 6 or 8%. So you wouldn't necessarily want to come at them with a very aggressive growth, because they would be saying, yeah, that's great and all, but I don't want my money tied up for 5 years. So the investment horizon, about syndication is I would understand the investor and then build the syndication or the investment around your investors versus trying to make your investor fit in the deal. Make the deal fit to your investors would be the best advice I have.
Sure.
So
I think a takeaway there is just each deal is unique, right? And so those splits and everything can change. And I guess are you setting up an LLC each deal, or as like a limited partnership, just to kind of keep voting rights with things in place? Is there any really one way you kind of prefer to go, or is it kind of just again case by case basis? I
mean, without getting too legality in it, I guess you can do it a couple different ways, but the simplest thing is just an LLC. But you label it as an SPV, a single purpose vehicle, meaning that it's just it's an entity. You could be XYZ building. It's an SPV, single purpose vehicle. The purpose of that vehicle is to do nothing but be owned by those limited, those partners. The LLC will be split between a GP and an LP. You do still need a PPM, a private placement memorandum. You still do need that. You need an operating agreement. PPM, a private placement memorandum, will outline this structure and all the legalities of it, about investing, what the GPs are responsible for. Because the thing is too, like, in addition to this, you also get manager fees. You can get management fees out of this. Typically, 1 to 2 to 3%, depending on the asset itself. But you can get management fees out of it, which we paid, and then you still get your splits and stuff. So, it can be pretty lucrative, I guess. Yeah. The biggest thing it does is it allows you to grow. Allows you to catch those bigger deals, because typically what you're looking at is really you need about 30% of a deal. So if you're looking at a $10 million deal, you may think, man, there's no way I can get a $10 million deal done. I need $3 million in equity, $4 million in equity. Well, using a syndication structure, it allows you to access that $4 million.
Sure. And
then if you got $4 million and you got say a 1.5 debt coverage ratio or better, you take it to any bank and they'll sign on you. With you might have to get one of your equity partners, one of your LPs to sign on, give them like 5 points of the GP
and I guess to that though, just making sure that you're even going through the process, you're only bringing on, vested clients, people that are at least in that position to help kind of finance that deal. We're not looking to you wouldn't want somebody that's all into this as far as like this is their life savings. So
you brought up a good point, which I skip over to a lot because I just automatically kind of jump to the 506Cs. Yeah. So underneath this, what makes syndication happen, even a thing, is really it's the Jobs Act. I think it stands for something startup deal. And basically, it's a Regulation D exemption filing for the securities office. And underneath that, the two main ones would be a 506B as in boy. B is accredited, but you can have up to 35 non-accredited investors. But you're not allowed to market. Like you can't be advertising, you can't be blasting it out on social media, stuff like that. And then you have 506C, which is accredited only, but it allows you to market and blast, and you can use any form process you want in order to raise that equity.
Sure.
And so those need to be outlined as well, because again, it goes back to, if you're accredited only running 506C, then a lot of times you're not really going to be, dealing with somebody that's their last 50,000 or last 100,000. But if it's a 506B, you may run into that, and you just got to vet those. You got to vet them to make sure that it's not their life savings. So.
Sure. Yeah. No, I appreciate you breaking that down, because I guess my familiarity with it and just come in was through a couple of means. Like, my background is just in like restaurant hospitality, of which I'm still kind of a limited partner as far as like an investor, right? But that was started basically as a syndication.
Mm-hmm.
And then I guess separately also is just from like an organization like a Bigger Pockets, right? Where Brandon Turner is just consistently raising money, where he's in his, I don't know, third or fourth fund going towards like a mobile home park or something like that. But that's all you hear on there, is it's only just to accredited investors, investors, just to make sure that you're not getting into those kind of waters.
Right.
I had somebody that this was their last 50 G's or something.
See if we have any questions.
Yeah, definitely.
Through a lot.
Yeah, we definitely.
Yeah, so I fire
we did
those
a
and answer
big
for
brain dump just there. So I mean, definitely we want to make sure we're opening that out to just anybody here, like in the room or online. Certainly, if you've got something in the chat box, make sure to go ahead and ask away. That was a lot of info right there for sure. And well, thank you so much. I mean, that was a killer breakdown. Do we have something on that?
No, there's one they could do.
Sure. So yeah, just let us know, right, if you have any questions or anything out there, because that was a lot. And Will brought some excellent handouts as well. So we're going to make sure that everybody has access to those. So here in our next email going out, that'll be the recording of this, and then we'll make sure to have that info. We'll do a pretty good breakdown of kind of an active deal it's got in place. Pretty cool stuff. Self-directed IRAs. So I am not an accountant or a CPA in this. So we're just kind of going to do some rough outlines as far as how those are set up, what you can kind of do a little bit of with them. And certainly I would always advise, right, just reach out, talk to your CPA, your financial advisor when it comes to setting up those structures. So as a self-directed IRA, you're able to go ahead and invest in things like businesses, stocks, bonds, gold, real estate, etc. You have to have what's called, though, as a qualified custodian, so somebody to still handle that money, because it's not just, even though you're a director of it, it's something that you still have to work through. And there's a couple of pieces throughout there as far as who that custodian can be, as far as how that stuff's distributed. So somebody, like, they can't be directly like related to you. It has to be kind of a neutral third party. It can be like a business partner of yours, but can't be a direct relative of it. So it must be owned purely for investment purposes. All the expenses of, say, a property have to be paid through that IRA, not by you directly. It's money you really just can't touch. Can't use like the furniture you currently own in a rental property. Any income generated has to be paid back to the IRA and not to you. So this is something that's still like a long-term parking as far as like investment goes. You can't use it to buy a property again from yourself or to a family member. So this has to be out there. This can be a third party, just somebody that's neutral to you, maybe a business partner or someone like that, but just can't go from say yourself. You can't buy yourself out or buy it something as a family member. So yeah, so disqualified persons, parents, grandparents, you and your spouse, your fiduciary and providers, children or grandchildren, anyone else not directly related to is who you can lend money to as far as what you're invested in. If you want to invest in a real estate project, you can lend the developer money as long as you set it up and choose your custodian ahead of time. That piece can be taken care of. You can raise cash from other people that have self-directed IRAs to kind of help fund your deals. So Will touched on that a little bit ago, just as far as being involved with some people that are using self-directed IRAs to fund into syndications. That's how some of this money can work. So when it comes to syndicates, and then that what can turn really is just boost your returns pretty quickly. I mean, over time, if you're really just using that money to lend out directly, say, to a syndicate or towards another investment, to then return back to you. As long as it stays inside of that wheelhouse, it's a pretty powerful vehicle overall. And I've got a couple of recordings with some CPAs that weren't actually able to make it here today, but we're going to make sure that those recordings kind of get out there just to help them kind of break that down a little bit. Definitely, again, just want to open this out to any questions out there. I mean, if you have anything in the chat or here in the room, just some more than open to it. Now's a good time.
I wonder if we could, does it make, I like the way Will explained it in the slides, although we have to maybe adjust it so it's more visible. They're real helpful if we could share them. See what sharing on my end.
Oh yeah, no, I mean, so I can run through them for sure. Yeah.
It's hard to see them on the screen.
Right.
The glare makes it tough to see them, but I thought they were pretty good at explaining the waterfall. Like, we can just tack them on at the end.
Yeah, we'll find a way. We'll either add it into like that email and we're gonna put our slides in there, or I'll look to see here in the editing piece just about actually like overlaying them as in there, just as like the edit, right? So we'll make sure definitely to get a lot of this info out there because it's a lot, right?
I have a question. So if I remember correctly, in Texas, you're allowed to pull money out of a retirement account to purchase a home, to go towards a home that you're going to purchase that you're going to live in,
Right.
not strictly as an investment. Is that the case here in Tennessee as well? I think it's limited to one time.
As far as like for a primary residence,
Right.
I think that's probably the difference in there too, is like, this is like purely for like investment properties, and not say like, I might be pulling it if I've been at, I don't know, use like, oh, you're just a big company that have got that in.
You repeat the question, so.
Oh,
Yeah.
Yeah, for sure. So I think what Will just said is just, if can you pull money out of, say, your regular IRA and putting it into like your personal property, as long as it's probably once? I believe that to be true, but I mean, I would certainly just reach out for clarification. But from my limited understanding of it, it's that that's different as far as your IRA from a company you might have been with for 20 years or something like that. That's treated differently than say like this, where like you are directing, because those kind of IRAs are usually oftentimes traded in the market. That's why when we had the crash, some people that had their life savings set up in some IRAs or trust with their companies, like those companies tanked, like so went their income, right? This is a way for you to really be protective of that at the end of the day, because you are directing the vehicle of which way to go. There's just some of those limitations in place as far as like who you can lend that money to directly. So it's a little bit more protective in it all. So what you're asking, if you can just invest like in your home, I think in your like a regular one, yes, but in this case, no, because you can't buy it like from yourself or pay yourself with it.
Well, I think the real question you're asking, the tax liabilities of it. Right, because you can take your money out of an IRA at any time, it's your money, but you're gonna pay, there's tax problems, that's why we have an IRA, there's some tax advantages. So when you do a withdrawal, I believe, yeah, there are exemptions. One time, the penalties are lower. I'm not an accountant. The self-directed IRA is strictly an investment vehicle. Like, it's separate from an IRA. And so because you have that manager involved, that involvement of that manager allows you to do what Will's talking. You can get into precious metals, you can get into real estate, you can get into commodities. It's called self-directed because you make the investment choices.
Yeah.
As opposed to putting your money in like a money market account, right? Or something, or investing with a fund manager or something where they're doing this. Or like you talked about having a fund directly, right? That's not self-directed. You're not calling me to ask me what we're doing with the fund.
Right.
You guys are running the fund, right? You have some obligations to report to me, but I'm not the one making the calls on what I'm investing or what I'm doing. So you can own rental properties and self-directed IRAs.
Yeah.
And you can do the Roth or traditional.
Mm-hmm.
I got a question. Can you pay yourself a management fee out of your self-directed IRA as a manager of that IRA?
That's a good question. I would say.
I've heard that you can.
Possibly. I mean, I suppose I could
like you pay
see
yourself
that.
A salary, you know.
It probably depend on like how you have it structured.
So you can pay expenses out of the self-directed IRA. So if you had an entity that was a property management company, then you should be able to pay expenses to that property management company.
Yeah, that would make
100%.
that makes sense.
Because
Sounds legit. So, yeah. I mean, yeah, like,
I mean,
no, why not? You're right. Yeah,
Yeah.
if you count that as an expense in your self-directed IRA, and then that's getting over to, yeah, this is.
So we have, for our real estate business, we have like a human resources business
Sure.
basically that pays all the bills.
You know,
Like the one asset and that does all those expenses, so there's layers there. Yeah, it
sure,
would be a way to do it, I
Yeah.
think. It would be logical.
that's pretty
to
cool.
make it just self-directed and pay
Pay
themselves.
themselves
I mean,
out of it
if
all,
this
yeah.
thing gets generating, I mean, it could be,
Yeah, if generating income,
it could be producing some serious revenue.
yeah, that's a way to just like,
But it
Really
sounds like
scale.
it's just like a lockbox. Like you just can't take the money.
yeah, you
back
just can't take
out.
the money back out.
You gotta, it's just like having a business, just like you should with a business, you're not touching that money. You
Yeah.
reinvest it back in the business, but it all lives inside that self-directed IRA.
Yeah, I mean, so certainly a powerful tool. I mean, because it gives you the options to set that up. And I would figure as much as that you could certainly open up a trust that would then
Trust is
operate LLCs that would then, kind of work from there as well. Because I mean, your trust would like to do what owns that IRA, and then from there that can go out into investing into companies and this few. Yeah, you're just kind of 1031 yourself over like through those companies.
I've got a question about apartment syndication, for Will, if I want to camera back on, but jump back up there is, what's the deal size? Typically, what's the amount of investment, the investment threshold? So we've got agents on this call that are working with investors. What's the kind of investor they should be pointing in the direction of apartment syndication?
But I can tell you. So what we do is we look back to understanding your investor. If you have an accredited investor that has $7,000, $4 million of liquid or, sitting around or available right now, they're going to more than likely, and again, I don't know everybody's level, but let's just be real. And I've been at this for a little while and I'm still at this level to where, those guys are going to go to Blackstone, BlackRock and Goldman Sachs, and they're going to go because they have the ability to go deploy several $100,000 and let it set for 10 or, 5, 6, 7, 10 years. So I look at your investor profile, and if you've got somebody that's accredited investor, they've got, a couple $100,000 or something like that. Me personally, what I do is I actually have a $25,000 minimum investment. And the reason why is because I just want somebody to transact with me and then let me earn their trust. There's nothing wrong. Like a lot of times we'll go back to them and say, hey, look, man, I know you did the 25,000. I really appreciate that. Everything's going really well. We've got a little bit more room left. Would you be interested in coming on a little more? Yeah, I could do 25 more. So then you step them up. It's $100,000 is a lot. I mean, a lot. If this is your first syndication, first 4 or 5 syndications, your track record is your biggest hurdle. Is proving that track record, proving your worth, your ability, not your worth, but proving your ability. And so I would recommend, if anybody's doing this or if they know somebody, there are great investors, great sponsors out there that have smaller thresholds. Typically, he's talking about like was it Brandon Turner? I think
Yes.
he's at the point now to where he's doing 100,000 minimum, probably because he's probably doing a $25 to $50 million fund.
Yeah.
And when you start getting in, like our funds right now, we're doing $5 to $10 million series of funds. So we'll do 5 million, fill it, close it, and do a 2, then 3, then 4, then 5, then 6. And the reason we do it from you don't want 1,000 investors at 25,000 a piece in your fund. It gets become an administrative nightmare. So depending on the size. So to answer your question, I would find, and I'm not trying to shameless plug here, but I would find like sponsors that have smaller funds, smaller deals and I say smaller, meaning, 2 to 10 million in acquisition size. That way they could get in with a $25,000 commitment, come in, whether they roll with it on the first one, that's fine. That typically, the smaller ones are typically this one here is a 3-year deal. So typically, we could be in and out in 3 years on this one. Well, they're going to come back, So it's harder to get $100,000. It's harder to get $100,000 out of somebody than it is to get 25,000. Now once you get to 25,000, you get the commitment. there's nothing wrong with building rapport after that and building up. You'll need to do that 100,000.
What do you think is the advantage of doing apartment syndication instead of just like individual investing, doing flips, or why are you seeing that people are attracted to doing syndication as opposed to?
I think the biggest thing, one is scalability. You know, you can scale syndications. Two is the check sizes are bigger. Let's face it, we're all investors. We're all here to make money, right? I mean, ethically make money. That's what it's all about. So if you've got you go out and get a flip and you can work your tail off for 3 months and say you make, right now is a great market. Say you make 50 grand. Well, that's great. But that's also what I call a capital gain investing. It's like, bam, here's your money. Whereas what syndication typically is with apartments specifically is more of cash flow. And it's reoccurring, it's passive. And so you may not, but I'll tell you, you go out and you work your tail off on a flip, make 50 grand, or you can do a syndication and say you have an acquisition fee of 50 grand. You'll make you get your marketing, you get reimbursements, plus you get the $50,000 acquisition fee. You make the 50,000 plus you own 35%, 40% of the asset. Yeah. So now you're getting cash flow. So you're getting acquisition fee, you're getting cash flow, you're getting management fee, you're getting you've got equity in the deal. So you're building your net worth. There's a lot of benefit to it outside.
Oh, sure. It makes sense. That makes perfect sense to me for the investors. So same question, right? Is the appeal for the investor? Is it the scalability, or is the appeal for the investor the passive nature of it? Like, no, I could do that, or I could just go give Will, invest some money with Will, work my day job, have my weekends on the boat with the kids, and then still have mailbox.
Not only that too, it also provides, especially real estate syndication provides great depreciation value. So like apartments, for example, real estate, what naturally depreciates over 27.5 years. So what we do is anytime we buy anything, we'll bring in that cash flows, we'll bring in and do a cost seg study. And so what they do is they go in and say, well, this refrigerator is only, all these refrigerators are only going to last 5 years. The plumbing's only going to last 7 years. And so you shorten that depreciation value to where our objective is what we call 100% tax advantaged income. And so if you got somebody coming in and they're investing, they're getting 100% trying to get 100% tax advantaged income.
That's a cost segregation study, right? To maximize the depreciation on that income. You
offset the obligation of the income. That's exactly right. Okay. And so for them it's hard. Plus it's real assets. Let's think about the reality of the economy that we're in right now. Like we're printing money like crazy. It's so real assets, that cash flow, especially anything that rents, because it's a great hedge against inflation because it ebbs and flows with inflation, right? Yeah. Inflation goes up, rents go up. That's the reason why rents are getting higher. Inflation comes down, rents go down. And so it just kind of ebbs and flows. You never really lose value of your dollar like you would if it was in, a stock. Like you said, it could plunge overnight. You got some safe bets out there that are going to, grow slowly, but a lot of times you can't. So there's a lot of benefits to real estate, especially cash flow in real estate. You can syndicate, like you're talking about, single family homes, fix and flips and stuff like that, but it's a lot harder. Yep. You have the carry period. You know what I mean? Like if you invest a couple $100,000 and say you flip a couple houses, you're not cash flowing. So you've got you may have 4 to 6 months of no payments, no nothing coming to the investor. So if you're going to do that, you might as well do development. Check sizes are bigger, so you might as well develop multifamily. But no, it's a beautiful thing, I think, for investors and for sponsors. Just on the sponsor side, you got to make sure you put your team together, get your, you got to check all the boxes, because these investors are not, they know what they're doing. They can smell a bad deal or somebody, that's not proficient in it. And, don't think that you've got to jump out and just do it yourself too. Like you can join a team, you can work with somebody.
Do syndicators ever pay finder's fees? You got agents on here, so that's one way. If you got an investor, you can still earn some. Is directing them to a safe investment. Yeah,
so there's again, there's some SEC regulatory deal with deal finding or sponsor or like a finder's fee. But yeah, we work with consultants. I will say that we work with consultants that can bring us some stuff, and bottom line is yes. The thing is like when they get paid, a lot of times they have to get paid out of like, we'll take our acquisition fee and pay. That way they're not getting paid out of the distribution as a finder's fee or something like that. You know what I'm saying? It's more of a consulting fee for us based out of our proceeds. And, but yeah, absolutely.
Just like an advertising expense or something, which makes sense.
Yeah, same thing with deals too. Like, I mean, I know a lot of times these broker deals are, you know, they're basing the sales off pro forma. I mean, we're not really looking on market. We got our first on market deal. It's a mobile home park down in San Angelo, Texas right now. It's the first on market deal we bought in probably 2 years. But it was a relationship with a broker too. It wasn't just a marketed deal. And you know, but if you're a residential agent or something like that, and you find a commercial asset or an owner, a lot of times the owner may be interested in selling or something like that, then, you know, we can still pay stuff on that as well.
Okay.
So,
I have a question just on, I guess Airbnb properties, like short-term rentals. Is that really something that people play around with, or is that kind of its own?
it's big.
Because
right
I guess
now.
we have a lot around here.
Yeah.
In ECC, certainly. I would think like the cabin market, or like we know the property in
Would that
the
be like
historic
Would that be
area.
like a portfolio or just the fund going out and acquiring a bunch of them?
I would look. You need volume. So like
Sure.
multifamily, the reason why it works so well, mobile home parks, the reason why it works so well with syndication stuff like that is because of the number of tenants that you have.
Right.
If you have a 30 room, I mean, on the small side, 30 to 50 room or unit multifamily or mobile home park, you know, you lose 10 people. I mean, you only lost 8% of your occupancy or something like that. So I mean, it's not terrible. But if you have one, I mean, let's face it, look at like COVID. I mean,
Sure.
you know, because don't get me wrong, Airbnb, I'm watching it. I watch all kinds of different strategies, and I mean, we're in debt. I mean, we're in equity. We're private debt right now is doing really well. You just got to be careful. I don't know where this COVID stuff is going. Personally, I don't know where this COVID stuff is going, and if it locks it down or whatever, and you know, that's your only means of income, then, you know, how long can you hang on to that asset, paying the finance, you know, the debt service every month? That's my only thing.
I get that, because like I would.
It's more volatile.
Yeah,
than long-term
and I guess that's
rentals.
where it makes sense. Yeah, and you would, I guess, want to hold like a number of them, but I guess also if say I were to apply it to our cabin market or something like that, right? And you might have a cabin that is $1.2 million, but it's generating $150K, $200K a year. Like, it's some good cash for sure. And yet I think what we saw at that point, I remember when lockdowns were first kind of going down, like it took a dip. Some investors got scared, backed out, right? Everyone personally like dipped out on had 2 of them under and out. And only then to see that like hockey stick, you know, in a sense, because then people like flocked to the mountains, it seemed.
Well,
and then things got
I would look for
and
me
then now that
personally
market's just
with Airbnb,
nuts.
it's very attractant driven. Like you said, the mountains, the beach, you know, like it's like even narrow it down. Like, you know, if you have a cabin that's Cleveland's Dome or something, I don't know, you know, like it's the premier location, then I wouldn't be as scared of that one as I would say, you know, East Knoxville.
Yeah,
you know,
I got you. Yeah,
you know, UT or something even. So I don't know. I think it's very, very location specific, but it's also it's not scalable for me neither. I mean, but there's definitely something to it though. I mean, it's getting traction.
Yeah. No, that's awesome.
And I think that's that Kai Andrews. We could talk about that another day.
We can totally dive into Kai's strategy.
You had an answer.
So Peyton had a great response to that. So she was just saying when we asked questions, or we were talking a little bit about how you can use that money out of your IRA. If you qualify as a first-time home buyer, you can withdraw up to $10,000 from your traditional IRA and use the money to buy or rebuild a home. You'll have to pay tax on the growth. With a Roth, you can take 10K of growth and basis for a home purchase, but there's some limitations into there. So I think it's a pretty good.
As always, call your accountant.
As always, call your accountant.
We are not accountants.
No, I'm not an accountant, not at least bit. But thank you very much for that. That was awesome. Jumped into. Don't forget, I mean, just leave us a review. Join us on Meetup or gridknoxville.com. Make sure to just check out RSVP for next month's meeting. That's going to be pretty solid as well. We're going to kind of end this call and kind of just jump here in the room.
if you're
Let's go there, find some
online,
deals.
put all your info. Yeah,
Yeah,
if you're
share your
online,
info.
put your info in the chat so that we can share that.
Share
If you
this.
want to have it shared with other investors, other people, we've got some different markets here. You want to include where you are. I've got Reggie, you're down in Savannah, I believe, right? Taylor and Dallas, you're in the Atlanta metro area. But if you want to get specific on where you are there, because it's a big enormous territory, that'd be fantastic. And Peyton, yeah, let us know where you're chiming in from and what you're looking for. Put that in the chat. We'll leave this up here for a minute, and we'll have the reporting out for you next week.
Cool. Awesome. Thanks, everybody. It's good stuff. I appreciate it all.